Britain's Guardian newspaper reporting this afternoon that France and Germany have agreed to boost the European Rescue Fund, that's the European Financial Stability Facility, to let's just call it 2 trillion euros. That's up from 440 billion euros. But late conflicting reports say that there could be a last-minute snag, another one. All right, well, let's see what happens with our taking stock think tank and the issues taking a look at the global economy and the connection with Europe. We have Dino Kos, Managing Director, Hamiltonian Associates, Dino Kos, Chief Market Strategist, ConvergEx Group, and Alessio de Longis. He is a Vice President, Portfolio Manager at Oppenheimer Funds. Gentlemen, good to have you with us. Yeah. All right, untie my tongue here, Dino Kos. What is going on in Europe? Does anybody really believe that this rescue fund is better than the rescue fund we had yesterday, which is better than the rescue fund we had last week? I mean, there's got to be like another one, right? I mean, just for the news cycle.
Well, certainly it's a work in process. The Europeans are understanding that they've got to get out ahead of the crisis. And so far that hasn't really been accomplished. They haven't gotten out ahead of the crisis. And with every iteration, we see some realization that the problem has gotten bigger while they've been waiting to catch up to the prior version.
Dino Kos, does something like this, and as Nick says, the idea that they have to get ahead of the crisis, does something like this indicate that they really don't have any idea of how to fix this? They just kind of punt it along and see what the market responds to?
Well, I mean, in my view, this is what they've done. This is assuming that the plan that they announce this weekend is along these lines. It would buy them some time. I mean, I think the market would probably give them the benefit of the doubt. It would push if you will, the day of reckoning out a few more months. But the underlying problems still remain. That you have, the single currency area. You have countries that are not all suited to be in that currency area, and at some point, either Europe will have to move towards a full transfer union, where money from the surplus countries gets transferred to the deficit countries, or else some of these countries will have to leave. Now, that's going to happen at some point, one of those two things. But in the meantime, they're going to try and sort of push the day of reckoning out into the future. They'll probably succeed.
Alessio, pushing the day of reckoning out into the future. I mean, does that sound really like a coherent plan?
Well, unfortunately it's the only plan that they can work for now, and I think Dino is absolutely right. We are addressing what is important with the FSF, and why the market reacted positively is that they are working towards preventing the domino effect, preventing the transmission mechanism to the rest of the economy from damaging the economy in excess of what the sovereign stress is already doing. But we are not addressing the core problem, which is lack of growth. We are focusing on the numerator of the problem, budget deficits as well as debt. But the real problem is the lack of strong growth in the whole of the euro area.
Dino Kos, the idea that the banking system in Europe is going to have to get smaller, do you buy into that?
It will. I mean, this may get a little too inside the beltway, if you will, but their loan-to-deposit ratio, they have too many loans for the number of deposits that they have accumulated. And so you've got two problems. One is this mismatch between loans and deposits.
They just lend too much money and they don't have enough cash in the bank
right. And so they've borrowed from volatile sources like U.S. money market funds. They're going to need to reduce that reliance, and part of that will be shrink the balance sheet, reduce loans. The other problem is that they don't have enough capital. So when you account for the losses that they will have to take from their bonds to these peripheral countries and also to the private sector in these countries, there's a lot of losses that they will have to take. The result is that they will have to shrink. And that's a problem because, as Alessio just mentioned, there is a growth problem in Europe. And if the banks are shrinking, that doesn't help the growth situation.
Alessio, can we make the distinction between consolidating and shrinking? Because there's been a lot of talk about consolidating, right? I mean, there was an example, I believe it was a couple weeks ago, about 2 savings banks in Spain, and they just Spain just had its ratings cut by Moody's today. 2 savings banks in Spain combining. Well, you had 2 kind of Tier 2 banks that were not very healthy. They combine. Why does that make things better? Do we just need to close some banks as opposed to consolidating them?
I think at the aggregate level, what matters is it's a problem of deleveraging, that a combination of recapitalizing the bank together with making them smaller is really the only way to address the problem. And that brings up an interesting transmission mechanism to the rest of the world, because European banks are the lion's share of cross-border lending all around the world. Think that of the G5 lending to the rest of the world, European banks represent 30% in in developing Asia, 50% in Latin America, and nearly all of the bank lending that goes to Eastern Europe. So that brings an interesting twist to this problem, which is that paradoxically, with the problem being in Europe and the deleveraging occurring in European banking system, you may actually get a very supportive supportive foreign exchange flow back into the euros at the expense of some of these emerging market currencies. The irony of this is that the euro may receive a negative flow from domestic problems, but a positive flow due to the deleveraging of its banking system.
So let me get this. The deleveraging that takes place affects Latin America, Eastern Europe, and developing markets in Asia because European banks have provided a lot of the money in order to fuel the growth in in the corporations that exist there.
Absolutely correct. And the problem is particularly concentrated in Eastern Europe.
All right, so if you have this problem, Nicolas, if the banks in Europe are responsible for all this lending, who's going to recapitalize them? Where's all this money going to come from? Does someone want to really buy bank shares? I mean, everybody wants to recapitalize at the same time.
Yeah, you're going to have to basically spread the pain, just like you sometimes when things are good, you spread the wealth. And spreading the pain means having private ownership of the banks continue to chip in more and more capital to try to fill the hole that's been created by the problems that have been outlined here. And as well, you're going to have public sector support. And part of the emblematic problem of this whole recession and hope for recovery from 2007 on has been not only do you have private shareholders taking some of the pain and putting capital in, but you have a lot of public sector money going as well.
But how do you get public sector money from countries like Germany and France when they won't even agree on how to prop up Greece, which only has 11 million people, yep. And I believe something like a fifth of them are employed by the government, and the government has yet to lay off a single public sector worker.
That's right. The only people not working are on strike right now in Greece. The layoffs haven't really started. The answer to your question is very slowly and carefully, and with a lot of attention to politics, because nobody wants to be seen as just bailing out Southern European countries. They want to be seen as being tough on them as well. That's a tough message to deliver to the Southern European countries that need the help. But in order to maintain the political flexibility to actually engage in that process, the Northern European politicians have to maintain an eye to the street and to what their citizens are saying.
Nicolas, I want to turn to you and just try to switch the conversation just slightly, because we saw this big move up in U.S. stocks today, particularly bank stocks. Been a lot of reports about exchange-traded funds and how exchange-traded funds influence stock price movements, both up and down. There's a Senate hearing, I believe it's tomorrow morning, about the influence of ETFs in the marketplace. You've done a little bit of work on this. What have you found?
Well, the Senate's interested in three topics. First of all, they want to know if ETFs in any way color the market. Do they imply or do they create volatility in the marketplace? Second, they want to know if it affects industry and market structure in the stock market. And then lastly, they're particularly focused on the leveraged funds, the 2 and 3x funds.
Right, those turbocharged funds where
Exactly.
you get to bet, 2 and 3 times the direction of a particular index.
Yep, they're concerned that those funds in particular provide some room for intraday volatility that wouldn't otherwise be there if the funds didn't exist. So they're going to be examining all those topics, questioning industry people, regulators, and critics of the industry as well.
And what have you found? Based on your data, you're saying that a lot of the conversation about ETFs is misinformed.
Yeah, it comes down to correlation versus causation. People look at the last couple of years and see that the rise of ETFs has been pretty much every year, every month. ETFs get more and more assets, and markets have been increasingly volatile. And so they assume that that correlation means causation. But if you look at the relative size of the industry, the ETF industry as a whole, every ETF listed in the U.S. is only $1 trillion in assets. The long-only community is 10 times that, mutual funds and so forth. And so the ETF industry is still relatively small. So it seems unlikely that in the macro it could affect the market the way the Senate is concerned about that it does. In addition, those double and triple funds are only $30 or $35 billion in total assets. And so given the total size of the U.S. equity markets, it seems unlikely that they could have a substantive and consistent effect on where stocks trade any given day.
All right, I'm glad you mentioned the word volatility, because then I get to ask Alessio about volatility in the currency markets. It seems as though we don't need exchange-traded funds as part of the conversation for volatility in currencies, right? All you got to do is look at Europe. Is that everything that people are trading? It's just all about what's going on in Europe? Is that what moves money?
Well, unfortunately, it seems that today, really, the foreign exchange market is completely driven by this, what we call headline risk, and all the headline risk is now related to Europe. We had a couple of months in the summer where the U.S. debt ceiling was the center of the attention, but now we're back in Europe. And, you know, if you look back during this year, I think the historical case, it will end up in history, what the Swiss had to do to stem Swiss franc appreciation. The Swiss franc had gone
linking the Swiss franc to the euro.
They had to create a floor, to commit to a floor against the euro in order to prevent their currency from continuing appreciating at the speed and with a volatility that it was unprecedented.
So people wanted to buy the Swiss franc because they were afraid to hold the euro.
Precisely. The Swiss franc was a symbol of the distortions that this crisis has created into the foreign exchange market.
Dino Kos, I want to turn your attention now to U.S. banks, because we looked at the results of Goldman Sachs, Bank of America today. We've also got the results of Wells Fargo yesterday. What do you make of the shrinkage in the balance sheets of banks?
Well, you know, the U.S. banks have their own transitions, so there are real pressures on their margins, and you're seeing this in their net interest margins, bank by bank. Revenues are under pressure because of proprietary trading restrictions.
Just to break in, net interest margin. Explain what that is for people.
So the difference between where the banks, what the banks pay depositors and what the banks make loans at. So as I mean, everybody knows. So if you're a depositor, essentially you're getting zero on your deposit. The banks were making loans at 4 or 5% not that long ago, but now because of what the Fed's doing, that's getting pushed down. So lending rates are following Treasury rates down, and because they can't pay depositors any less than zero, their margins are getting squeezed. So we've got that. Then we have proprietary trading restrictions. So this
Citigroup just coming out saying they're getting rid of their proprietary trading unit, right?
They're getting rid of it and the like. So you've got that, and that's affecting banks. And then you see the problem with the banks trying to increase fees in other areas. They increase a fee, and Congress goes on the warpath. So you have, the banks are under pressure on the revenue side on all fronts, and you're sort of seeing this now, where even though some of the credit metrics are getting a little bit better in some areas, and there's some demand in commercial and industrial loans, for example. But on the other hand, there's just not enough volume, there's not enough demand, and you've got these margin pressures. So the banks have some wood to chop, as it were.
And do you think this is going to go on for a while?
It's going to go on for a while. When you look at the Japanese situation, the banks have had trouble now for many, many years because as interest rates stay low across the curve, margins just cannot get going, and demand doesn't get going.
I want to thank you very much. Dino Kos joining us from Hamiltonian Associates, Dino Kos, ConvergEx, and also Alessio de Longis from Oppenheimer Funds.